Investing is one of the most effective ways to build wealth and achieve financial freedom. We got stocks, bonds, real estate, mutual funds, index funds, and alternative assets like gold and precious metals, and even cryptocurrencies. Now, each investment type has its own risk-reward profile, and choosing the right investment depends on multiple factors: risk tolerance, financial goals, and investment knowledge. Now, before we dive into stocks and investing, I want you to really understand why you need to be investing your money. You see, just saving your money alone is not enough anymore, because inflation erodes your purchasing power of cash over time. Let's say you have $10,000 sitting in a savings account only earning 0.5% APY, which is low-key higher than most banks. But after 1 year, your balance only grows to $10,050, which sounds good, right? You're making money. But now I want you to factor in inflation, and assuming it's 3% per year, the real value of your money drops to $9,757. In terms of purchasing power, you low-key lost $243 just by keeping it in a savings account. Damn! Remember, the longer you keep your money in low interest savings, the more you lose to inflation, which is why a lot of people will tell you to put it in a high yield savings account just so you can try to outpace inflation. Let's see what would happen if you invest this $10,000 in the stock market with an average 8% return. And this is going based off the kind of historicals for an S&P 500. After a decade, your investment would be worth over $21,000. So instead of your money shrinking to around $7,000 due to inflation, your investments have grown to $21,000. That's like almost 3 times as much. The bottom line here is that saving alone will not build wealth. And while you should always have an emergency fund and save some of your money, keeping all that cash in a savings account guarantees that inflation might eat at it. Investing also allows your money to work for you and outpace this inflation over time. And one of the most common investment types that I mentioned earlier is stocks. And those have historically been proven as a way to build wealth for the average American. Now, stocks represent ownership in a company. When you buy a stock, you own a piece of that business. And companies issue out stocks to raise capital for expansion, product development, and even operational improvements. Investors, everyday people like you and me, buy these stocks in hopes that, the company will grow, increasing the stock price and generating returns. According to history, right, the stock market on average has brought in a return around 7 to 10% per year, making it, again, one of the best long-term investment vehicles. However, it does require patience and a well thought out strategy. Let's say you buy 10 shares of a company at $50 per share. That means your total investment is $500. And if that stock price increases to $70 per share, your new portfolio value is around $700, which means you made a $200 profit. If that stock drops to $40 per share, your investment is now worth $400, meaning on paper, you lost $100. So remember, stock prices fluctuate and your returns depend on when you buy and when you sell. But don't worry, I will show you later in this video how to find winning businesses and companies to invest in. When it comes to investing in stocks, it's important to understand the distinction between common and preferred shares. Now, investors typically choose common shares for growth potential, while preferred shares appeal to those seeking stable income. To be honest with you, more than most likely, when you start to invest in stocks, you're gonna be buying common shares. But again, I just wanted you to make sure you're aware of this difference. Before I dive into choosing specific stocks, you need to first select the right investment account. The type of account you choose will impact your tax obligations, your investment options, and just like your overall financial strategy. So the top 5 options when it comes to investing in stocks is your IRA, 401k, a regular brokerage account, an HSA, or a 529 plan. At the very least, most people should open up an IRA, 401k, and a brokerage account. These accounts are excellent tools for steadily building your wealth over time. Now, when it comes to your 401k and IRA, the decision between traditional and Roth depends on your current and future tax situation. While with the HSA and 529, these are optional and really depend on your personal needs, whether you want to save for medical expenses or education for your children in the future. And trust me, I low-key just hate saying do what works best for you, because I know a lot of you want a direct answer, but I need you to remember that personal finance is personal. And someone that has a 529 plan might be doing that because they want family in the future, while someone else probably doesn't want to have kids in the future, so they won't need it. But with that being said, let me show you which accounts I use, just so you have visibility kind of on how I think about it. For me personally, I have a 401k through my employer, and because I make extra money through side hustles, I contribute to a traditional 401k just to help reduce my taxable income. I also opened up my Roth IRA at the age of 18, and it's one of the best wealth building tools out there because like when I retire, all of my gains will be tax-free. Lastly, I have a regular brokerage account as well because once my retirements are fully funded, I invest any extra money I have into that account. It's also important to remember, and I just want to make sure that I'm clear here, that retirement accounts, right? Like your 401ks and your IRAs should generally not be touched until you reach the age of 59 and a half, which is like when you retire. And while there are some exceptions, the goal really is to keep your money invested in those accounts for retirement because again, if you withdraw early, you might have penalties. If you want flexibility to buy and sell stocks anytime and access your money instantly, this is where a regular brokerage comes into play and it'll be the best option for you. By choosing the right investment accounts and leveraging compounding over time, even the smallest amounts, whether it's $100 or $10 a week, a month, that can regularly grow into substantial wealth. Remember, investing is not about getting rich quickly, it's about building financial stability and achieving long-term goals. Now that you understand why you need to invest and which accounts are at your disposal, let's focus on buying some stocks. And believe it or not, buying stocks is simpler than ever as it was before in the past just due to online brokerages. With a couple clicks, you can become a shareholder in a company and start building your investment portfolio. But you need to remember, and it's also important, that understanding the process is essential to making sure you make the most informed investment decision. So the stock market operates Monday through Friday from 9:30 a.m. to 4 p.m. Eastern. Now, some platforms offer pre-market trading and even after-hour tradings just to allow investors to place trades outside regular market hours. However, after-hour trading is often kind of with lower liquidity and higher volatility, so don't worry too much about that. Selecting a brokerage account is the first step when it comes to buying stocks. Some popular brokerage platforms are, Fidelity, Charles Schwab, Vanguard, Robinhood, E-Trade, or Interactive Brokers. And when choosing a brokerage account, I really just want you to consider factors like trading fees, research tools, and most importantly, the ease of use. Me personally, I use Charles Schwab because I bank with them, right? I have my brokerage account with them, I have my Roth IRA, and I have my checkings account with them. So with all that being in one place, it's easy for me to transfer my money between accounts. With that said, just do your research and choose a platform that works for you. You low-key really can't go wrong with choosing any of these major options. But my personal advice is stick to well-established, reputable banks and brokerage firms just for security and reliability. Now, let's dive into actually buying stocks, which is where most people have the most questions because it's confusing. So for the first step, open up a brokerage account with one of the platforms that I mentioned earlier, and then you're gonna transfer your money from your bank account to your brokerage account. And this process may take a few days, so just be patient. And now once your funds are available, I want you to go to your brokerage app and use the search function to find a stock you want to buy. Stocks are usually identified by their ticker symbol, and if you're unsure about your company's ticker symbol, just do a quick Google search and you'll be all set. Next, you'll need to select the order type for simplicity, and just for this video only, choose market order, which will buy the stock at the current price. Finally, review your order, confirm, and execute the trade. And that's it. You're low-key like now an investor. It's also important to remember that when stocks are sold for a profit, that counts as income and you will owe taxes. These taxes are known as capital gain taxes, and they may either be short-term or long-term capital gains tax. So the tax rate really depends on how long you held these stocks before selling them. And if you're ever unsure when it comes time to file taxes, always consult a certified public accountant, also known as a CPA, as they know best. There are other tax considerations you should be mindful of when it comes to investing, but again, I don't want to dive into like each individual tax implication, so just refer to a CPA. But nonetheless, I always want you to make sure you're aware of them, because by understanding these tax implications, you can help plan your stock sales strategically and minimize your tax burdens when it comes time to filing your taxes in the next year. In the stock market, the main investment options, right, are stocks, index funds, and mutual funds. Individual stocks require research, but they offer high growth potential, and investors can buy basically specific shares of companies they want to, aiming for capital appreciation. And now index funds is essentially a collection of stocks that track a market index. For example, the S&P 500 tracks the top 500 companies in the US, and they're passively managed and offer diversification with lower fees, while mutual funds are actively managed, where professional managers pick stocks, bonds, and other assets. And since they're actively managed by people, these usually have higher fees, but they also have that professional oversight. Even though they are professionals, sometimes they don't even beat out the regular index funds. And now some investors will also argue that buying individual stocks allow for greater gains, while others prefer index funds for diversification and stability. It's also important to remember that hedge funds and institutional investors have access to advanced data, millions, billions of dollars, making it difficult for the average investor like me and you to outperform the market consistently. And even though they pour millions of dollars into their companies, most of the time, they're not even able to beat the market. So to settle this debate of stocks versus index funds, many successful investors, including Warren Buffett, recommend index funds for beginners, or especially for people that are anxious or afraid of the stock market, because index funds offer simplicity, but they also allow for consistent, long-term, strong performance. The key to investing is consistency. Investing regularly, regardless of the market conditions, help you smooth out volatility and take advantage of dollar cost averaging. And with DCA, you can invest a fixed amount at regular intervals, which reduces the impact of short-term market fluctuations and essentially lowers your average cost of your investment over time. If you look at the chart, you can see how consistently investing every month allows you to buy stocks at both their low and high points, which means you're gonna average out the cost over time. Now, if you're trying to time the market, it's really risky because you can never predict when the bottom will be. So the best approach is just to stay consistent with your contributions and let dollar cost averaging work in your favor. Investing should not have to be a one-time event or something you do sporadically. Instead, I want you to consider setting an investing schedule based on your financial and income goals. You can do monthly contributions, bi-weekly contributions, or even lump sum investing, but just figure out what makes sense for you. Because again, remember, consistency in investing ensures that you remain disciplined and make progress towards your financial goals. Dividends are payments that companies distribute to shareholders, often on like a quarterly basis. So instead of pouring all that money back into the business, they sometimes gift their shareholders. And now some investors use these dividends as passive income, while others kind of just reinvest it in additional stocks to help accelerate their wealth accumulation. I want you to take a step back and imagine earning $100 doing nothing. So to achieve this $100 per month, which is around $1,200 per year from dividends, and let's assume you're investing in a stock or index fund or ETF with a 3% dividend yield, essentially what that means is to get passive income of $100 per month, you need to invest around $40,000 in that stock or ETF. And I know $40,000 is a lot, but people are earning serious money by focusing on high quality stocks that also have good dividends. And this entire process is known as dividend investing. Reinvesting dividends allow for compound growth, which means your money earns more money over time. And many brokerages offer drips, which essentially means that they'll automatically use your dividend payouts to purchase additional shares of stock, which means you're increasing your investment without having to add additional cash deposits. So now let's say you want to invest $1,000 in a stock that pays a 5% annual dividend. Instead of withdrawing the $50 dividend payout, you reinvest it. And over time, when you reinvest those dividends and you buy more and more shares, you're essentially increasing your holdings and compounding your return. Every dividend payout, you get money, but instead of using it, you buy more stocks, more stocks, more stocks, and with drips, this happens automatically. One caution I do want to warn you about is do not solely focus on investing in companies with high dividends. While dividends are attractive, it's important to make sure you're investing in strong, financially stable businesses, which we'll cover later. But a dividend yield may seem appealing, especially when it's high, but if that stock price of the business drops significantly, you can end up losing more money than you actually gain in dividends. So remember, always prioritize selecting the correct business first, then worry about the dividends. And before we dive into stock analysis and strategy, please make sure, please make sure you have an emergency around 3 to 6 months of living expenses. Remember, investing is a long-term game and market downturns happen, but having a safety net prevents you from selling your investments at a loss because you might need quick access to cash. A well-funded emergency account allows you to take calculated investment risks without jeopardizing your financial security. The main thing I want you to remember is that investing is a marathon and not a race. Go at your own pace, and the only thing you really need to worry about is showing up every day, every week, every month when it comes to investing. And by simply understanding how to buy stocks and the tax implications of selling them, you can easily, anyone can legit easily make informed investment decisions that maximize their returns, but also minimize the unnecessary costs. When it comes to investing, there are different strategies based on risk tolerance, research, your approach to investing, and even your time horizon. However, the two most common investment approaches really is individual stocks and index funds. And within each of these, there are even more specific strategies. But the goal of this video is to keep things general, high level, and give you the foundational knowledge so you can kind of just do your own research after this and after you decide, am I interested in stocks or index funds? Now, index funds are essentially a basket of stocks, meaning that instead of spending $100 on a single stock like Apple, you can invest that $100 into a fund that, let's say, has holdings of Nvidia, Google, Meta, Coca-Cola, and many other companies. The key benefit is that a fund mimics a specific industry or market sector, allowing you to diversify your investment and reduce your risk compared to just picking individual stocks. The most common index fund out there is the S&P 500, which tracks the top 500 companies in the US. And if this fund were to ever hit zero, essentially the global economy would collapse, meaning you low-key have bigger concerns than investments, as you need to figure out how you're gonna survive. And now historically, the S&P 500 has provided around an annual average of 10% over a 10-year period, making it one of the most reliable long-term investment options. And while there are many other index funds that you can explore, the S&P 500 remains the go-to choice for most investors. And by most investors, I'm not talking about like kind of the average American, even for millionaires and billionaires. Most millionaires put their money into index funds because it's the easiest and most passive way to invest while still earning strong, consistent returns. Think about it. If you had $1 million and invested in an index fund returning 10% annually, that's an extra $100,000 per year without lifting a finger. So why take unnecessary risks on individual stocks when you can grow your wealth reliably with index funds and you won't have to worry at all? For those that want to invest in individual stocks, successful investing involves understanding financial statements, earnings reports, and market trends. And some of these key metrics, to evaluate when analyzing a stock is the PE ratio, earnings growth, debt levels, dividend yields, market trends, and cash flow. There's a bunch of things you have to know. And just a bonus tip here, I want you to take the time to also evaluate a company's CEO, as they set the tone usually for the business and they play a key role in its future direction. And while I don't have a strict, checklist for assessing CEOs, I personally prefer visionary leaders, especially those without a traditional business degree. And even though I have a business degree myself, I find that engineers and artists tend to be more forward-thinking, innovative, and consumer-focused, and often drive real change and solve meaningful problems for the consumer. Once you start doing your own research, you will come across different investment strategies when it comes to picking out individual stocks. The two main strategies that you'll come across is value investing and then the opposite of that. And both of these strategies have their merits, but long-term investors tend to favor value investing just due to its historical success and lower risk profile. When it comes to technical analysis, using stock charts and patterns can be useful for short-term traders, but low-key, it's not necessary if you're doing long-term investing. And while some traders really rely on moving averages, the RSI, candlestick patterns, long-term investors focus more on the company fundamentals and overall market trends. Remember, long-term is investing and short-term is gambling, so don't worry too much about those charts. And although financial statements, and these ratios are crucial to understanding stock prices, it's also important to note that stocks are influenced by news and media coverage, the investor sentiment, and economic conditions, which is why, again, short-term price movements can be misleading, and long-term investors really just benefit from holding long-term and holding steadily through these different market cycles. As mentioned earlier, trying to time the market is risky, but a buy and hold approach has historically led to the best returns. Investors who stay in the market for the long run benefit from compound growth and avoid the emotional pitfalls of panic selling. Remember, time in the market, being consistent, and having a healthy, diversified portfolio is the best balance for long-term investing approach. And by sticking to this disciplined long-term investing strategy, you increase the chances of building significant wealth over time. After giving you all of this information, I want to share with you how I invest my money, just so you can see kind of how I approach it as well. I'm currently 25 years old, and my main focus is investing in my Roth IRA, 401k, and then using any extra money after everyday expenses and savings to invest more in stocks or back into myself, i.e. my side hustles and business. One important thing that I learned when it comes to investing is attaining your first 100K. Once you get your first 100K, your money really starts to work for you, and it's the most crucial milestone in wealth building. The power of compounding becomes much more noticeable once you reach this threshold. And compounding works best really when you reinvest your gains, allowing your investments to generate returns on top of previous returns. But what makes attaining your first 100K so difficult is that more than most likely you'll have to save your way there, and the only way you can speed up that process is by increasing your income. When it comes to my Roth IRA, knowing $100,000 is an important milestone and that I can only contribute a set amount to a IRA basically every year, I like to focus on high growth individual stocks, which can help accelerate my portfolio's growth. However, as I mentioned, this approach comes with risk, so please make sure you do the proper research and you have patience, because those two things will definitely be required. Once my portfolio reaches past that 100K mark, diversification becomes important to preserving my wealth, because again, it'll reduce the risk of a single stock kind of significantly impacting my portfolio. So at this stage, right, once I hit that 100K mark, I will shift my stocks to index funds within my Roth IRA. Just to recap, this is my current approach when it comes to investing, which follows a structured approach that balances growth and risk. And during this entire investing journey, the key lessons learned along the way is having patience, avoiding the need to always feel like you need to trade, staying educated, and sticking to a financial plan. By focusing on high quality investments, maintaining consistently, and gradually shifting towards a diversified approach, I'm building a portfolio that aligns with both my short-term and long-term financial goals. Investing does not have to be complicated. By focusing on high quality investments and staying consistent, anyone can build wealth over time. If you found this video helpful, please don't forget to like, comment, subscribe, and share. And be sure to check out my channel for more stories and tips about leveling up your finances.